Imagine a single line in a January 2026 price list triggering millions of dollars to move across borders in a single week, legally, invisibly, and without a bank transfer. What looks like a harmless catalog update actually rewrites incentives across retail, resale, and the hidden pathways wealth uses to cross jurisdictions. Today we'll unpack exactly how. In early January 2026, several Swiss luxury houses, Rolex foremost among them, raised retail prices. Those increases weren't just sticker shock for collectors, they rewired the economics of buying, holding, and moving high-value goods. You'll hear how the mechanics drove those hikes, how tariff changes and rising gold pushed markups, where arbitrage windows opened, and critically for investigators and compliance teams, the repeatable red flags that expose when value is being lawfully optimized versus intentionally obscured. Quick disclaimer, this is educational only. This is not legal, tax, or compliance advice. Consult licensed professionals for decisions about purchases or investigations. Start with the facts. Rolex implemented a global price increase effective around the 1st of January 2026. Industry outlets reported average US SRP increases in roughly the mid-single to high single digits, think 4 to 9% depending on metal and reference. Other Swiss houses followed similar catalog resets. These moves came after a year of policy whiplash. Emergency US. Tariffs in 2025 were revised but remained materially above pre-2024 levels, and gold and other precious metal inputs rose through late 2025. A 5 to 7% SRP increase isn't uniform across references. Gold and two-tone models saw larger percentage bumps tied to raw material inflation. Press commentary singled out gold references as bearing the brunt. Those model-level deltas change which watches trade above SRP on the secondary market and which suddenly look like bargains. If the manufacturer raises price today, where does the market first show it? The boutique, the auction, or across borders? The path matters. Tariffs are a blunt instrument, but they move economics quickly. In 2025 and into 2026, headline reporting described emergency levies on Swiss imports, followed by a recalibration that left applied rates materially higher than before 2025. Applied rates in some categories moved to the mid-teens by late 2025. For high-value items, a 15% tariff on landed cost is enormous. Authorized dealers in lower tariff or duty-free jurisdictions suddenly become arbitrage hubs. Legitimate buyers will fly to Switzerland or the EU, purchase, declare, and pay duty, or exploit duty-free allowance rules. That is lawful, but the tariff differential also creates incentives for non-transparent behaviors, delayed importation, use of bonded warehouses, or invoice timing tricks to avoid new duty rates. If you had a 7% SRP hike and a 15% tariff added to import into the US, where would you buy first? The answer explains a lot about rapid cross-border transfers we saw in January. When SRPs rise suddenly, there's a lag before secondary and gray markets reprice. That lag is an arbitrage window. A popular steel Daytona might still trade at or above SRP in the US, while a gold variant jumps in SRP and becomes scarce on secondary sites. Buyers who predict demand can buy in lower price jurisdictions and resell where the SRP is higher, or hold until secondary prices catch up. Legal arbitrage is one thing: buy in Switzerland, declare import, pay duty, resell. Illicit flows use the same mechanics differently. Invoice misdescription, over or under invoicing to shift value on paper, and timing imports to take advantage of duty changes or refunds. Those are trade-based money laundering techniques that exploit catalog changes and tariff updates. Now let's walk through a realistic three-market flip to show exactly how value can be shifted or concealed. Imagine EU to US to Middle East. Step 1. Purchase in an EU boutique before the price hike is fully implemented locally, or in a low-tariff EU country, paying with a mix of wire and structured third-party payments. The dealer issues an invoice listing a lower descriptor or an older SRP to match the pre-hike price. Step 2. Ship to a US consignee with temporary storage under a bonded arrangement or private concierge. The importer declares the item under a prior shipment date or uses bonded warehouse rules to defer duty. If duty rates have changed, timing customs clearance can reduce immediate tariff exposure. Step 3. A private sale in the U.S. to a Middle East buyer. The resale invoice reflects a higher price, but the documented chain has mismatched values. Purchase invoice shows X, resale invoice shows Y, the delta is the paper profit. Money can be routed through multiple accounts or paid in cash, making bank detection harder. Step 4. Rapid onward movement to a third market where valuation is opaque and provenance gaps exist. The custody chain is short, boutique to concierge to private buyer to reseller, reducing time for regulators to reconcile records. These steps can include lawful elements, bonded storage, legal resale, private sales. The difference between lawful arbitrage and illicit concealment lies in consistency across documentation, declared duty compliance, and customer due diligence. Observable signals emerge: mismatched invoice values, sudden geospatial sales spikes, and concentrated cash or third-party payments. Investigators and compliance teams look for measurable anomalies. Key data points are price spreads by SKU and geography, sudden geographic sales, odd transfer chains, and inventory or till anomalies. Public SRP catalogs are time-stampable. Compare country-by-country SRPs by SKU to secondary platform listings and major auction results. If a certain model shows a 20% spread between country A SRP and country B resale, that's an alert. Geographic spikes matter. If a small group of boutiques report outsized sales on a specific date, for example the day after the catalog release, that's suspicious if accompanied by cash or third-party payments. Investigators cross-check store till records with shipment manifests and watch movements on shipping networks. Inventory and till anomalies are very telling. Enforcement cases show boutiques or secondary dealers retroactively altering invoice dates or processing structured payments to avoid reporting thresholds. Repeated cash or voucher use by the same buyer profile in a short time window is a red flag. What's more suspicious? A single high-value purchase with full provenance, or a rapid chain of 3 identical pieces moving through bonded storage in 48 hours? The latter deserves deeper scrutiny. For frontline teams, here are repeatable, data-driven red flags to triage suspicious activity. Flag sustained SRP versus observed resale deltas greater than 10% immediately after a catalog change. Watch for invoice anomalies such as mismatched buyer or seller names, shifted invoice dates, inconsistent item descriptors, or values that don't align with model and type. Monitor payment anomalies, third-party payers, structured payments just below reporting thresholds, or repeated cash and voucher payments. Track rapid custody chains boutique to concierge to reseller within 48 to 72 hours, especially when crossing jurisdictions. Look for concentrated sales at a single boutique on or immediately after price list changes. Scrutinize bonded warehouse use without subsequent customs clearance or with inconsistent duty declarations. And watch for sudden geographic resale pattern shifts, like a specific SKU flooding a market that was previously quiet for that model. Detecting these signals is one thing. Building a case is another. Enforcement cases show how time-stamped catalog pricing combined with suspicious payment flows creates probable cause. Auditing authorized dealer tills and inventory is effective. Auditors often find mismatches when comparing bank receipts, point-of-sale records, and shipment manifests. Cooperation across jurisdictions is essential. Cross-border resale spikes are where trade-based money laundering becomes visible, and sharing SKU-level data across markets helps unravel the chain. Not everything that looks suspicious is illegal. Lawful arbitrage remains a staple of collector behavior. If a collector buys in Switzerland and properly declares and pays duties, that is lawful. Auction houses and authorized dealers can structure sales across markets legitimately. Collectors should insist on full provenance and clear invoices. Dealers should tighten till controls, require proof of identity, and flag multiple high-value purchases with unusual payment mixes.